Silence is not the absence of noise. Sometimes it is the sound of systems failing at once. Screens still glow, numbers still move. But underneath, something critical stops working. Markets depend on trust, timing, and flow. When one piece breaks, the rest does not slow down, it locks. At the center of that risk sits a small island that rarely makes daily headlines, yet quietly controls the pulse of the modern economy. This video explores how a single political decision, made without a single shot fired, could freeze global markets in real time. Not through chaos in the streets, but through silence in supply chains. No alarms, no countdowns, just delayed shipments, unanswered orders, and factories waiting for parts that never arrive. The world does not crash loudly anymore, it stalls. This is not a story about war in the traditional sense. It is about leverage. Taiwan is not powerful because of its size, population, or military reach. Its power comes from precision, from factories so advanced that no country can easily replace them, from machines that produce components so small they are invisible to the human eye, yet essential to everything from smartphones to fighter jets. Most people know chips matter. Few understand how deep that dependence runs. Fewer still realize how quickly the damage would spread if access to those chips were cut off, even temporarily. This video breaks that chain down, step by step, in simple terms. Not theory, not speculation. Just how the system actually works. A blockade does not need explosions to be effective. It needs patience, control of routes, control of timing, control of uncertainty. When shipping lanes tighten, insurance costs spike. When insurance costs spike, cargo stops moving. When cargo stops, factories pause. When factories pause, markets react. The reaction does not wait for confirmation. Algorithms sell first. Funds rebalance next. Confidence drains fast. This is how panic travels in modern finance. Faster than news, faster than politics, faster than reason. By the time official statements calm the public, the damage is already priced in. What makes this scenario different from past market crashes is not scale alone. It is concentration. In previous crises, production could shift. Alternatives existed, even if they were slower or more expensive. With advanced chips, there is no quick substitute. Years of expertise are locked into a handful of facilities. Tools that take decades to master cannot be replicated during an emergency. This creates a pressure point unlike oil embargoes or currency shocks. Those affected prices. This affects capability. When companies cannot build products, revenue forecasts collapse. When forecasts collapse, valuations follow. Trillions do not vanish overnight. They evaporate as expectations reset. Yet this video is not only about collapse, it is about contrast. While most sectors bleed under this kind of stress, one area behaves differently. Money does not disappear in a crisis, it moves. Governments do not freeze, they prioritize. When strategic risk rises, spending shifts toward protection, resilience, and control. This creates a strange imbalance where fear destroys some industries while reinforcing others. That exception is not obvious to most investors. It rarely trends on social media. But history shows the pattern clearly. This video explains why that sector stands apart, how it absorbs shock instead of amplifying it, and why long-term capital quietly flows there while headlines focus elsewhere. Viewers who stay until the end will understand something most discussions miss. This is not about choosing sides or predicting dates. It is about understanding incentives. Markets are not moral, they are reactive. States are not emotional, they are strategic. When these two forces collide around a single choke point, the outcome reshapes more than stock charts. It reshapes supply chains, alliances, and future planning. Knowing where pressure builds before it releases is the difference between reacting late and seeing patterns early. Along the way, this video reveals lesser-known details that rarely make mainstream coverage. Why some countries prepare silently while others speak loudly. Why certain companies hedge quietly years in advance. Why a temporary disruption can cause permanent shifts, and why the most powerful moves often look boring on the surface. No countdowns, no speeches, just paperwork, rerouted ships, and delayed approvals that slowly change everything. If global markets were to freeze, it would not feel dramatic at first. It would feel confusing. Orders delayed, earnings calls cautious, guidance withdrawn. Then comes the realization that this is not a dip. It is a reset. Understanding that process before it happens is the purpose of this video. Not to scare, but to explain. Not to predict the future, but to show how fragile the present really is. Welcome to our channel, where we break down complex global risks into clear, simple stories that help you see what others overlook. If you value calm analysis over noise and depth over headlines, subscribe now and stay with us until the end. Taiwan matters more than oil because oil can be stored, redirected, substituted, and slowly phased out, while advanced chips cannot. Oil powers movement, but chips power decision-making. Every modern system now depends on tiny processors that think, calculate, verify, and control. Taiwan sits at the center of that reality. It does not dominate because of land or force. It dominates because it produces the most advanced semiconductors on Earth at a scale and precision no other place can match today. These chips are not luxury items. They are not optional upgrades. They are the invisible backbone of modern life. Phones rely on them to function. Cars rely on them to run safely. Banks rely on them to clear transactions. Weapons rely on them to guide, detect, and respond. Artificial intelligence relies on them to learn, predict, and optimize. Remove the chips and the systems still exist on paper, but they stop working in practice. That is why Taiwan is not just a tech hub. It is a central node in the global operating system. When people hear the word semiconductor, they often think of consumer electronics. That is a mistake. Chips are embedded everywhere. They regulate electricity grids. They manage hospital equipment. They coordinate logistics networks that move food and fuel. They allow satellites to communicate and aircraft to navigate. The world does not run on oil alone anymore. It runs on information, timing, and control. Chips deliver all three. Taiwan specializes in the most advanced versions of these chips, the kind that cannot be replaced by older models without breaking entire systems. This creates a dependency that goes far beyond convenience. It creates structural reliance. A disruption involving Taiwan is therefore not a regional problem. It is a global system issue. The modern economy is built on efficiency, not redundancy. Companies reduced backup suppliers to cut costs. Nations trusted open trade routes to remain open. Over decades, production concentrated in the places that did it best. Taiwan became one of those places. When everything flows normally, this looks like progress. When flow is interrupted, it becomes fragility. The reason this matters more than oil is speed. Oil shocks unfold over months. Reserves are released. Prices rise gradually. Consumers adjust. Chip disruptions move faster. There are no massive stockpiles of advanced chips sitting unused. Production is finely balanced against demand. Missed deliveries ripple instantly through schedules and forecasts. One delayed shipment can stop an entire factory line. One paused factory can miss revenue targets. Missed targets trigger sell-offs. This is how something technical becomes financial and then psychological. A Chinese blockade does not need spectacle to work. It does not require invasion, occupation, or open conflict. A blockade is pressure applied through control rather than destruction. It is about restricting movement, increasing uncertainty, and forcing delays. Ships do not need to be seized. They only need to wait. Insurance companies react first. When risk rises, premiums spike. Some routes become uninsurable. When shipping firms cannot insure cargo, they hesitate. Hesitation creates delay. Delay breaks contracts. Broken contracts create legal and financial exposure. All of this happens quietly. No dramatic footage, no urgent speeches, just paperwork and risk assessments changing behind the scenes. Trade routes near Taiwan are among the busiest in the world. Even partial disruption changes global shipping patterns. Ports congest. Containers pile up in the wrong places. Time-sensitive goods miss deadlines. In high-tech manufacturing, timing is everything. Assembly plants depend on parts arriving within hours, not weeks. When those parts do not arrive, lines stop. Workers wait. Machines sit idle. Costs continue, but output falls to zero. Speed is the key factor. This is not a slow-moving crisis. Supply chains today operate on tight schedules optimized for efficiency. There is no slack. A blockade does not need to last years to cause damage. Days are enough. Within the first week, manufacturers issue warnings. Within the second, earnings guidance is revised. Within the third, layoffs are discussed. Markets do not wait for confirmation. They price in risk immediately. Traders sell on expectation, not outcome. Automated systems amplify the move. Volatility feeds on itself. Fear spreads faster than facts because fear requires less information. It only needs uncertainty. When companies cannot say when production will resume, analysts cannot model future cash flows. When cash flows cannot be modeled, valuations collapse. This is how confidence evaporates. The domino effect begins in financial markets because markets are the most sensitive sensors in the system. Stocks fall first, not because factories have stopped yet, but because they might. Equity prices reflect future earnings, not present activity. As soon as supply risk appears, future earnings are questioned. Tech companies are hit immediately, but the damage does not stay there. Manufacturing firms follow because they rely on components. Logistics firms follow because volumes drop. Banks follow because loan risk increases. Pension funds follow because asset values decline. This is not a chain reaction that respects sector boundaries, it crosses them. Manufacturing freezes next, not all at once, but unevenly. Some plants shut down completely. Others operate at reduced capacity. Inventory buffers disappear. Backlogs grow. Customers wait longer. Delays become the norm. Consumer confidence then collapses. Not because people understand semiconductors, but because prices rise and availability falls. Cars become harder to buy. Electronics are delayed. Services slow down. People feel the system straining. When confidence drops, spending drops. When spending drops, the slowdown deepens. Fear spreads faster than facts because facts take time to confirm. Fear only needs a trigger. Social media accelerates this process, but it is not the cause. The cause is opacity. Supply chains are complex and global. No single authority can provide a clear picture quickly. As a result, rumors fill the gap. Investors react to worst-case scenarios. Companies hoard components if they can. Governments issue cautious statements that often add to uncertainty rather than reduce it. The scale of loss approaches trillions not because value is physically destroyed, but because expectations are reset downward across the board. Market capitalization reflects belief in future growth. When growth assumptions change simultaneously across many industries, the numbers add up fast. The figure often cited around $12 trillion is not a precise calculation. It is a conceptual estimate derived from exposure. Start with the total market value of sectors directly dependent on advanced chips. Add the secondary sectors that rely on those sectors. Add the financial instruments tied to their performance. Consider the multiplier effect of reduced spending and investment. Compare the scale of global equity markets to the share affected by semiconductor disruption. The result is a number so large it feels abstract. That is why it matters. Large numbers numb attention, but behind the number are concrete effects. Jobs delayed, projects canceled, innovation slowed. This kind of shock is different from past crashes because it is not rooted in excess or fraud. It is not a bubble inflated by optimism. It is not bad loans hidden on balance sheets. It is a sudden stop of reality, a realization that production cannot continue as assumed. In previous crises, central banks could inject liquidity. Governments could stimulate demand. Those tools address financial problems. They are less effective against physical constraints. You cannot print chips. You cannot stimulate production that requires facilities unavailable or inaccessible. Time becomes the limiting factor. Even if new factories are planned, they take years to build and staff. Training skilled workers takes even longer. This means recovery is slower and uneven. Some regions adapt faster, others lag. Inequality widens. Political pressure increases. All of this feeds back into markets, reinforcing volatility. The most unsettling aspect is how quietly this unfolds. There is no single moment where everything breaks. Instead, there is a sequence of small disruptions that accumulate. Each one seems manageable on its own. Together, they overwhelm the system. Orders delayed by a week become delays of a month. A month becomes a quarter. A quarter becomes a missed year. By the time the scale is clear, much of the damage is already done. This is why understanding Taiwan's role matters. It is not about predicting a specific event. It is about recognizing a structural vulnerability that exists right now. The world has built extraordinary capability on top of a narrow foundation. When that foundation is stressed, the effects propagate outward, touching nearly every aspect of modern life without announcing themselves loudly. The losses do not spread evenly, and they never do. The first impact hits technology companies, not because they are reckless, but because they are closest to the source. Advanced chips are their lifeblood. When access tightens, production schedules collapse almost immediately. Product launches are delayed. Software updates lose impact because hardware cannot keep up. Cloud providers face capacity limits. Data centers slow expansion plans. Revenues that depend on constant upgrades suddenly face pauses they cannot explain away. Investors react fast because these companies are priced for growth, not survival. Even a small disruption forces a reassessment of future earnings, and when expectations fall, valuations follow. This does not take months, it takes days. From there, the damage spreads outward to industries that appear unrelated at first glance. Automakers are next. Modern cars are not mechanical machines anymore. They are computers on wheels. Chips control braking systems, navigation, battery management, emissions, and safety features. Without those components, a finished car cannot leave the factory, even if every other part is available. Assembly lines slow or stop. Dealers face shortages. Prices rise. Consumers delay purchases. The slowdown feeds back into manufacturing jobs and supplier networks. Defense follows closely. Military systems rely on specialized chips for communication, targeting, and coordination. Delays here do not only affect companies, they affect national planning. Contracts are postponed. Budgets are reallocated. Urgency increases, but solutions are limited by the same bottleneck. Finance then feels the strain. Banks are exposed through loans to affected companies. Payment systems depend on uninterrupted digital infrastructure. Market volatility increases risk. Lending tightens. Credit becomes more expensive. Logistics companies are hit as volumes fall and routes change. Fewer goods move. Ships wait longer. Warehouses sit half empty or completely full in the wrong places. Efficiency drops. Costs rise. The impact does not stop at borders. Countries far from Asia feel it just as sharply. Geography offers no protection in a globalized system. A factory in Europe waits for components made using Taiwanese chips. A hospital in Africa depends on equipment controlled by processors designed there. A bank in South America clears transactions through systems reliant on advanced hardware. Distance does not reduce dependence. It hides it. The modern economy is a web, not a set of isolated blocks. When one central strand tightens, the tension is felt everywhere. Governments may reassure their populations, but reassurance does not move goods. Even nations with strong domestic industries rely on imported components at some stage of production. No country produces everything it needs, at the level it needs, on its own. That is the trade-off that enabled decades of growth. The cost of that efficiency is vulnerability. Losses accumulate through simple cause and effect. Parts do not arrive. Production slows, revenue falls, jobs are threatened, spending declines, confidence drops, markets respond. Each step reinforces the next. There is no single villain, no dramatic turning point. Just friction building until movement becomes impossible. This is why there is no escape through geography. Even countries with minimal direct trade with Taiwan are connected indirectly through partners and intermediaries. Supply chains overlap. Financial systems are interlinked. Shock travels through contracts, currencies, and expectations. Amid this broad damage, one sector behaves differently. It does not escape unscathed, but it does not collapse in the same way. This exception is not obvious at first. It does not announce itself with soaring headlines. It moves quietly, almost defensively. The reason lies in incentives. In periods of chaos, priorities change. Governments shift focus from efficiency to security, from cost reduction to resilience, from short-term profit to long-term control. This redirects money rather than eliminating it. Capital seeks safety, predictability, and necessity. It flows toward areas aligned with state interests and structural demand. This sector benefits not because it is immune to disruption, but because it is central to managing disruption itself. Demand for its output increases when uncertainty rises. Budgets that might have been debated in calmer times are approved quickly. Planning horizons extend, contracts become longer. The logic is straightforward. When systems are stressed, maintaining stability becomes more valuable than maximizing growth. Spending follows that logic. Investors notice this pattern not immediately but steadily. Money moves away from sectors exposed to consumer sentiment and toward those backed by long-term commitments. Crises do not destroy all value. They reprice it. The idea that wealth simply disappears is misleading. It shifts from vulnerable areas to those perceived as essential. This is why some sectors see inflows even as markets fall. It is not speculation, it is reallocation. Insurance against uncertainty becomes a product in itself. Governments act as buyers of last resort, providing a floor under demand. This creates a buffer that other industries lack. As this shift unfolds, the contrast becomes clearer. Companies dependent on discretionary spending suffer because consumers pull back. Companies tied to strategic priorities gain because those priorities harden under pressure. The reveal does not come in a single announcement. It appears in budget lines, policy statements, and procurement plans. Calm analysis shows the pattern before excitement does. The reason this sector gains while others collapse lies in the difference between short-term panic and long-term thinking. Markets panic because they react to uncertainty. States plan because they must operate through it. When uncertainty rises, governments do not step away. They step in. Demand shifts from optional goods to essential capabilities. Funding moves from expansion to protection. Long-term projects are accelerated, not cancelled. This creates stability for suppliers aligned with those goals. Government priorities reshape demand curves. What was once incremental becomes urgent. What was once negotiable becomes non-negotiable. This shift is not emotional, it is practical. Systems under stress require reinforcement. That reinforcement costs money, and that money must go somewhere. Investors who understand this do not chase rebounds. They follow incentives. Calm explanation builds trust because it removes drama. There is nothing mysterious about this behavior. It is rational adaptation to risk. While many industries wait for normal conditions to return, this sector plans for conditions to remain uncertain. That mindset attracts capital looking for durability rather than growth. Over time, the gap widens. One part of the economy contracts, another stabilizes. The difference is not luck, it is alignment with the realities of a stressed global system. Power is often misunderstood because it is usually confused with volume. Loud moves look strong, fast reactions feel decisive. But real control rarely announces itself. It operates in silence through preparation, patience, and positioning. Markets react emotionally because markets are built on expectation. They surge on hope and fall on fear. Systems do not behave that way. Systems move quietly, adjusting in the background, reallocating resources, tightening weak points, and reinforcing what matters most. When noise fills the air, true power is usually somewhere else, waiting. In moments of stress, speed feels like strength, but speed often creates mistakes. Those who rush reveal their urgency. Those who wait reveal their confidence. This is why the most influential shifts are rarely visible in real time. They unfold through policy, investment, and long-term planning rather than headlines. While attention is focused on daily price swings, deeper decisions are already shaping the next decade. The future is not decided by who reacts first, but by who can afford to be patient. Understanding this difference changes how risk is seen. It shifts focus away from panic and toward structure, away from surface reactions and toward underlying incentives. The world does not change in a single dramatic moment. It changes through quiet adjustments that only become obvious after they are complete. By the time most people notice, the balance has already shifted. If this perspective helped you see global power, markets, and systems more clearly, stay with us. We focus on calm analysis, not noise. If you found value in this video, like it to support the channel, share it with someone who thinks deeply about the world, and subscribe so you don't miss what comes next. Real understanding takes time, and the most important signals are often the quiet ones.